I want to say welcome. My name is Beth Mwachi, and I am here with Kaler Financial Group for our webinar, Retiring in Uncertain Times. We know we've faced an incredible, difficult year with so many uncertainties and so many things that have come up in this past year. So we are excited to hear from Rick Kaler and Nathan Gehring from Kaler Financial Group here, talking about, what are the things we need to think about when we're retiring and in uncertain times. Does that make a difference, or what do I need to be doing? So we are going to pick up with Nathan, and he is starting off with the important years around financial planning, the 5 years before and the 5 years after. So go ahead and join us in this webinar, and then we will circle back at the end.
This is the period of time where market movements, particularly downward market movements in a portfolio, will have the most negative impact on the rest of your retirement. And it creates a ton of uncertainty and is really the most challenging point as you prepare for retirement. So if you're not confident that your retirement plan is on track to deliver the lifestyle you want amid uncertainty, you're in the right spot. We're going to bring a lot to you over this hour. We're going to discuss how uncertainty impacts your cash flow, give you some ideas and questions and thoughts to deal with, or how you deal with a recession as it strikes, or how you deal with strong market movements against you, how to prepare for uncertainty, and give some thoughts about if you should be making any moves right now or thinking about anything right now as retirement approaches, or if you're in retirement.
So the important thing to do is to really focus on what you can control. Somewhat like the Serenity Prayer, help me to understand the things that I can control, the things I can't, and the wisdom to know the difference. That's the summarized version. So there are a lot of things to focus on, like, what's out of your control are markets. Nobody saw the pandemic coming. I guess I shouldn't say nobody. There were people in government and scientists that said it was inevitable, but very few of us saw that coming, and even fewer saw the market impacts that a huge recession would not develop from that. I mean, there's just a huge amount that was out of control with what has happened. And unpredictability is where we live life. Financial planning is actually probably a poor term. It's as if we can plan with certitude for life. And the fact is that we can't. So we can control what we can control, and then adapt when things change, when economies change, when our life changes, when we really need to pivot. So that's the important thing that we really have to stay focused on, is what can I control? And there's some critical questions around this that we can ask, and we'll just we won't hit all of these questions, but we'll hit a couple of them. And first one is, am I emotionally prepared for uncertainty? And I mean, how can we be emotionally prepared for what we can't see or what we don't know? Where we run into a lot of emotional problems is when we have really rigid beliefs on how things work, how money, especially how money works. And that, for example, a belief that the stock market will go up all the time. And some of you might say, well, Who could believe that? Well, we really haven't seen much of a down market since 2000, early part of 2009. We had the little 11-day bear market back in March of 2020. But for some of us, our emotional systems have gotten very used to, well, markets go up. They may drop a little bit, but they go up. Am I really prepared for a 10-year period where markets don't go up? Has that ever happened? Yes, that's happened. So we call these beliefs money scripts, and the more certitude we have around how money works, what money is, how markets work, how taxes work, etc., the more potential pitfalls there are for really not being prepared for uncertainty. Because we get into the, when uncertainty happens, we start arguing with what happened, like, wait a minute, this can't be happening. This isn't how it's supposed to happen, rather than being flexible and rolling with what happens. Nathan.
Second question we'll touch on here is, am I confident in my ability to adapt to changing conditions? Particularly in this 10-year window, the 5 years before retirement, the 5 years after retirement, adaptability is really critical. And there are two big pieces in this question. First is, yes, having the adaptability built into a retirement plan. And what might that look like? It could be the ability to delay retirement for a few months, a year, several years even, in really negative market environment. It could mean having cash on hand to use if market conditions deteriorate early in retirement. Having a good handle on spending and knowing where you can make adjustments in spending if necessary. But it's also having the confidence that you do know where you can adapt. So it's both this emotional piece and the very mechanical ability to adapt and having things laid out. So in March last year, as markets were tumbling and as things got very fearful, we reviewed every one of our retired clients or near retired clients' financial plans to determine what the impact of that market crash was. And was there anyone that we needed to speak with about making changes and adapting to these changing conditions? I felt confident that most clients would be fine. We knew they had prepared financial plans that were very conservative and very safe. And it turned out that was the case for the vast majority. There was nothing to change, nothing needed to happen. But some clients had decided to build a retirement that included more risk in it. Why? It allowed them to live, spend a little more now, maybe live a little larger now, recognizing that, yeah, perhaps some change might be needed in the face of dramatically negatively changing conditions. And we had a handful of clients where that was the case. We had to call them. We reached out to let them know this is in fact one of those events. Remember the plans we made? It's time to do that. And what were those plans? I think in one case it was consider retiring a year later. Client was fine with that. In another case, it was draw back the spending a little bit. And remember, we'd had this conversation around where you might do that, and it happened with no problems. So the ability was there to adapt, and the client was confident going into it because the conversation had happened and had been considered.
And talking about protecting your retirement cash flow, as you were describing that, Nathan, I was thinking of those clients that we did visit that we were concerned about, and that so many of them, because of the way the pandemic happened, we really didn't have a spending problem because folks were spending less because they weren't doing anything. They weren't traveling. Oftentimes we don't have a unforeseen crisis that built in is we're not going to have a problem with overspending. So that was one of those silver linings with the type of crisis that the pandemic was. So, you know, in retirement, it's really, really important that we have some type of a plan to access cash, access income, because basically what we're saving toward all these years in retirement is to fund retirement income. It doesn't really do a lot if, let's just say all of our retirement, all of our net worth is in a Western South Dakota ranch that isn't producing, even a percent worth of return. It all comes down to how am I going to get money out of all of my investments? So going to our critical questions. The first one is, do I have enough cash to avoid drawing down on my portfolio when it's lost value? And this is of real concern. Many decades ago, we just would withdraw from the portfolio monthly as we needed. But the problem became when markets do go down, which they do. This is a really poor time to be withdrawing from your portfolio, because a portfolio that's down 20% is going to take a lot more growth to increase. So what we have determined, and what has worked really well, is to ask yourself, how many years would I like to take off the table? How many years of income would I like to put aside into a fund? So I don't have to draw down or withdraw from my portfolio when markets do decline. And everybody's answer is a little bit different as far as what they're comfortable with. The typical kind of the default number of years we use is 2. So for example, if a person was withdrawing $3,000 a month from their portfolio, then we would like a reserve of $72,000 or 3 years. And the way that works is when that $72,000 is drawn down to, say, 1 year, maybe, or to $36,000, that we then go in and replenish it, take it back up to 2 years. And of course, if the markets are down when that happens, then we continue to draw down on that until A, we absolutely have to go into the portfolio to fund it, or B, markets recover. And generally speaking, 2 years is a pretty good time to figure that a market's going to have recovered. If it's going to be down a decade, of course, that's really hard to fund against. But typically 2 years is pretty adequate. But we have some clients that have 5 years worth of income that's taken off the table. Now, the annoyance to that is often, well, but it's in cash and we're earning anything on it, which is just about correct, 0.05%. But this isn't an investment. When you're taking cash off the table to fund retirement income, it's not an investment, it's insurance. So when we view it that way, it's a lot more palatable than to think, oh, look at the earnings that I'm losing. Well, yeah, but look at what you could be saving if markets do go down, you've had that cash there. So that's one of the things that we think is really important to look at when it comes to cash flow.
Another question we thought we would touch on, but not go into any depth in this point because it's too large a conversation, is would I benefit from additional guaranteed income in retirement? And what we mean there is almost everyone has some form of guaranteed income in retirement. This is the income that comes in every year, every month, whatever it might be, and you can rely on it, not connected to markets in any way. What's the big one? Social Security retirement benefits. The vast majority of retirees will have some form of Social Security. That's the most basic guaranteed income, and it forms the base of retirement spending. It's the money you can rely on for the rest of your life. Other examples of guaranteed income might include an employer or government pension, or potentially some kind of lifetime annuity that pays an income stream to you for the rest of your life. And this guaranteed income acts as ballast during times of market turmoil. A retirement plan can be built knowing, well, with certainty, we have enough income coming in to cover whatever the number might be, 70% of our expenses, irrespective of what the market's doing. So now we're just looking to fund that difference out of the portfolio. It provides for a certain amount of cash flow to pay retirement lifestyle expenses. And there's an increasing amount of research that suggests increasing guaranteed income through the use of something like an immediate annuity can meaningfully increase the sustainability of a retirement plan, and even on occasion allow for more spending in retirement than would be possible just with a portfolio in a more traditional stock and bond type situation. But is it right for everyone? No, certainly not. Maybe not even for the majority of the people. The academic research might suggest it is. Yet there's this behavioral downside that's really challenging, and that's simply, I've heard it from clients, I don't know how many times. It's an interesting idea, but I know if I put my money into an annuity, I'm going to die the next day. Hear it over and over again, and I would frankly feel the same way. It's this emotional fear and reaction to the idea. Some circumstances, it's great. It's a question to consider whether additional guaranteed income might be beneficial. And sometimes it doesn't work at all. Final question we wanted to touch on here was, have I done an analysis on my portfolio to determine how much is safe to withdraw? And this is a huge question. It's not a simple question to answer. There's a ton of research on safe retirement withdrawal rates. Knowing how much you can safely withdraw and having an idea of how likely it would be to make adjustments allows retirees to build a lifestyle that they'll be able to fund comfortably. There's a long-standing traditional rule, really a rule of thumb around safe withdrawal. It's that an individual can withdraw 4% of their starting portfolio on the date of retirement, and then increase that for inflation each year, assuming that person's invested in a well-diversified 60% equity, 40% bond portfolio. It is just a rule of thumb. It's not necessarily applicable to any individual, but it's also a rule of thumb that a lot of financial planners still use just as a quick guide to see, to compare to as their clients draw money out. You don't want to be wildly over that, although in a certain year, an individual might be higher or way lower. But for each individual, the number can be wildly different. So having a retirement plan to help you understand what that safe withdrawal rate is for you, whether that's expressed as a percentage like 4% or an actual dollar amount that you can take out, goes a long way to protecting your retirement cash flow and making sure you're not taking out too much regularly.
So one thing that's really important that we do is to revisit our investment strategy. And this is important to do at any time, but it's really important to do prior to retiring, to make sure that your portfolio is set up correctly for what your needs are. And there's lots of myths out there regarding how you set up a retirement portfolio and glide paths, which aren't necessarily a myth. A lot of different opinions and strategies. And I think one of the most common is I have to put my portfolio in lots of income producing investments. Of course, today, there's not too many investments that produce income, but traditionally that's been bonds or high dividend paying stocks. And there's a little bit of a myth that the only thing that we can spend is what an investment throws off. And that's not true. The concept is one of total return. What's the total return? And it goes back to what we talked about before of it's more important that you have money, that you get your income from what is set aside, not from what the investments are producing. So one of the first things that we want to ask ourselves in preparing for our retirement allocation is it appropriately diversified? You know, going back to having all of our investments in one chunk of land or in our small business, or even all in a S&P 500 index fund, this probably is not going to set us up well. I recently attended a workshop where they said we have learned in our research over the years that the best way to avoid risk when investing is to think small. And by that, they meant small amounts of lots of different investments. And this is basically our strategy, which is one of being conservative and one that we think works very well, especially in retirement. Because in retirement, we don't have the years to rebuild an investment mistake. A young person could put 100% of their money into stocks, even a focused fund of stocks, not that all that diversified, and have a number of years to let it grow, let it recover, and let it go, where they don't need to be drawing on that money. But it's completely different when we're preparing for retirement and when we are in retirement. We need to build a portfolio that pays a lot of attention to diversification. And I like to think of diversification on steroids, global diversification, diversification at every asset class that's out there. And in doing that, we can lower the volatility of a portfolio. And actually, by lowering the volatility of portfolio, we can increase the amount we can withdraw. And we probably don't have time to get into that. Like Nathan said, we could take every one of these questions and have a whole workshop around it. But let me just say that portfolio diversification is crucial, and that doesn't mean having an index fund of 3,000 stocks and that everything's in that. It means having bonds and different types of bonds and real estate and commodities and maybe some alternative asset classes. Okay. Nathan.
Yep. So a very related question to this diversification issue is, am I protected against sequence of return risk? And as we've already discussed, the dangers of withdrawing too much from a portfolio that's fallen. And sequence of return risk is a very specific thing. It's a huge topic, but we thought let's touch on it briefly and take a minute to explain it at the highest level. So at the beginning of this, we discussed the fragile decade, the 5 years before retirement, the 5 years after retirement. Sequence of return risk exists throughout an investing lifetime, but it's in that fragile decade where it has the most potential negative, or could also be positive, but really negative consequences. What sequence of returns simply means is the order in which the returns occur year to year in a portfolio. So if you had two portfolios, they can have an identical return. Let's say the two portfolios both return 6% per year over a really long time frame. But one portfolio has a bunch of bad years at first as someone retires, and then a bunch of good years later on. And the other portfolio does the exact opposite, a bunch of good years at first and a bunch of bad years later on. That first portfolio with the bad returns early would result in less wealth and less ability to fund a lifestyle than that other portfolio with all the good returns at the beginning and the bad returns at the end. So this is sequence of return risk. It's why this 10 years is so important. It's why bringing volatility down around retirement is so important, because big drawdowns as you're heading into retiring or early in retirement are really hard to recover from. Your portfolio drops 20%. If you weren't taking money out, it takes 25% to get back to the same spot. But if your portfolio drops 20% and you have to take money out, well, now you've just magnified the amount of growth needed just to get back to even. So That's what we're talking about. Earlier, someone younger, far from retirement, sequence of return risk kind of works the opposite way. It can almost be a positive thing. But in this 10-year window, certainly, this is the risk. This is where you really want a portfolio to be steady and not have big drawdowns, and have set aside some cash in the event. Just bad luck, you retired January of 2020, March, we saw everything drop. Let's not take any money out. And in this case, that would have been perfect. A year later, things are looking rosy. That's it. A super complicated topic, really critical, something we think about all the time for our clients as they approach retirement or as they've entered it, and something really to put some consideration into as you're thinking about retirement.
Totally. And Nathan, to follow on with what you said about the importance of reducing volatility in your portfolio and that sequence of return risk. One way that we can further reduce volatility is investing in something that's called alternative investment strategies. Sometimes they're referred to as long short strategies. Everybody has a different definition of what's included in alternative investments. So I would ask you to hold that concept loosely. But what we're talking about typically are either investment classes or investment strategies that aren't bonds or stocks. The typical retirement portfolio is 60-40. Well, what's that mean? That means 60% in US stocks and 40% in US bonds. That's classically what 60-40 means. What we find is that portfolio still has some volatility, and we can actually reduce the volatility of a 60-40 portfolio by adding a lot of other asset classes like international stocks to it, international bonds, TIPS bonds, which are indexed to inflation, high yield bonds, things like this. But those are still pretty plain vanilla asset classes. We can go a step further by adding things like commodities. Now, when we talk about commodities, we usually go, the futures market. No way do I want to take that type of risk. There's a way to put commodities in your portfolio that's unleveraged and actually has less volatility than putting real estate investment trust, which could be another alternative investment. So that it's not as volatile as one thinks if it's unleveraged. The decade of the commodities was the 70s, right? So like for the between 2010 and 2020, commodities were a huge loser. This decade so far, commodities are way up over the last year. Will this be the decade of the commodities again? We don't know. And that's really important. We don't know. That's why diversification is so important. But you can go to other asset classes that are still not as commonly known as real estate and commodities. You can go to, for example, there's an investment strategy called managed futures. And again, that it has that futures word in it, which seems to be inherently risky. But if you take a look at this particular asset class and go back to 1989 and follow it, it has volatility that's less than stocks and a return of somewhere between bonds and stocks. There's another asset class that I've recently come across that I wrote a column on a few weeks ago called reinsurance. And it's taking a position of insuring insurance companies to where the real risk, there's no economic risk. It doesn't matter what stocks do. It doesn't matter what interest rates do. All it matters is a natural disaster. And again, we could do a whole webinar on this. But the point is, it's a different asset class. It makes money. I think the average return in one of those asset classes is 11% since 2003, and another is 6%, right? So it has a positive return over time. The key is we're looking for something that ideally when stocks goes up, this goes down. And when the alternative goes up, stocks will be down. That's how we take volatility out of our portfolio. So this is one of my favorite topics. And I think in the interest of time, I need to stop. But it's something that we look very seriously at, and it's not unusual that a third of our portfolio might be in alternative investments. So some things that we don't want to do, after talking about things we do want to do, is we don't want to be consumed by fear over uncertainty. You know, that fear can just be paralyzing. And uncertainty is absolutely there. You know, just it's something that cannot be avoided, like death and taxes. So to someone that has some fear, it's really important first not to ignore it, not to put it aside, not to pretend it doesn't exist, not to be critical of yourself and say, well, uncertainty is normal, I should not be feeling this fear. The first thing to really not being consumed by fear is to acknowledge it's there, and to not try to resist it or push it away. And there's a number of ways we can do that. You know, one of our expertises as a firm is financial therapy and helping people look at their emotions around money. And research tells us that 80 to 100% of all financial decisions are made emotionally. Depends on which research you want to follow. So that's really important that we do that. Nathan.
So here are the critical questions again we would present to you as you consider how fear plays into your retirement planning. First one we'll touch on here is, do I have a clear anxiety-free decision-making strategy for my finances? Really what this involves is determining likely decisions you're going to encounter to certain questions, making a decision in advance, and it can really take a lot of the emotion out of some of those financial decisions. One way to do this is to use a process known as policy-based financial planning. In policy-based financial planning, the idea is to envision potential uncertain events occurring and then predetermining how you're going to react to those events and making decisions about those events. Basically to create a policy. So if X happens, we will do Y. If A happens, we will do B. But doing this ahead of time, doing this before fear has hit, before you've been flooded with emotion, doing it in a time where you can approach it rationally, where the decision isn't creating pressure yet. And one of the most researched, one of the most discussed policy-based financial planning policy-based decision matrices that gets discussed often is a withdrawal strategy. There's a lot of research around making good withdrawal decisions out of a portfolio during retirement. And what do these look like? They all differ a little bit, but basically they begin with determine a good withdrawal rate that's expected to last forever, and then make some decisions around increasing or decreasing that withdrawal rate based on markets go down. We might not take an inflation adjustment in a year, or we might even have to reduce spending, or markets really go wild. Hey, we can have a raise that wasn't anticipated. But the idea is, in the absence of emotion, sit down, create a policy where you make decisions. And then when the event occurs, perhaps markets crash and you have to make that decision, well, you've already made it. You just go to the policy, you look at that policy, and you know, we decided if this happens, we're going to do X. Now, it might still be difficult to make that decision in the moment, but at least you've taken the time to think about it rationally without the emotion. Perhaps with the help of a friend or a professional, you can be reminded this is the decision that makes sense in the absence of emotion. We should just go with that. Or if something really has materially changed that falls outside of that policy, you can reconsider it.
Yeah, and another question that we need to ask around fear is fear leading me to take on too little risk in my portfolio or give up too much in lifestyle? And what we mean by that is I can be so risk adverse that I want everything safe. I don't want my investments to have the chance to go down at all. Well, what that means is basically investing in a certificate of deposit or cash or some type of cash equivalent. Well, those aren't paying very good right now. I think the last that I checked, a 90-day CD was 0.05%. You can't really retire on that. I mean, you can retire as long as you're okay spending principal, right? And maybe you've got enough principal that you don't need a return, all right? Well, and that's important to address. So I'm not saying in all cases it would be a wrong answer to have things in CD. It could be absolutely the right answer. But the question is it fear that's causing me to take too little risk when really my retirement plan would suggest that I need a 4 or 5% return out of my nest egg over a period of time. But I have so much fear about seeing the balance decline at any one time that I just can't live with that. So, in that case, it's really important to take a look at what are the messages, what are the thoughts, feelings, and beliefs around the fear, because in that case, it's not going to serve us well. It's going to be self-sabotaging. The other side of this is being so fearful of spending that we underspend. And this is a real common problem, especially with our clients who have amassed what wealth they have because they're frugal, right? I mean, we've got to spend less than we make to build wealth. So that's really hard just to turn off when we get into retirement. And I remember a conversation I had with a long-term client, and my plan showed that they could be spending 120, 140,000 a year, and they're spending 40. And I was trying to sell them on a round the world cruise, or, how could we spend a little bit more that would bring joy to you? And they're like, we're plenty happy. And they were okay giving up the lifestyle, but you could be leaving lifestyle on the table because of fear. So the don't number 2 is don't put off critical decisions. Sometimes just sitting on the sidelines is safe when there's all sorts of uncertainty. But inaction can become dangerous because a decision not to do anything is still a decision, especially if we become vulnerable to things. So when we get closer to retirement, or if we're in retirement, we don't have the luxury of a 20-year-old or a 30-year-old has of just waiting or doing nothing. And sometimes we're doing nothing because we can be paralyzed with fear or paralyzed with uncertainty. I talked with a client yesterday that says when she feels under pressure with money, her words is, I go dumb and I get really fuzzy. So it's really important for us to go into action around times when a critical decision needs to be made. So some of the critical questions around this is, am I reasonably confident that my retirement strategies can adapt to unexpected and unseen conditions? How can we have that confidence when we don't know what it is that we're adapting to? One thing that we do with our portfolios is something that's called stress testing or scenario testing to see, given everything that we can think of, which are often 60, 70 different scenarios, how would portfolios react? So you can have your portfolio stress test or tested for certain things, like what happens if we have a 2008 recession? What happens if we have runaway inflation, which is a popular concern right now? What happens if Iran gets the nuclear bomb? I mean, all sorts of things that we can have some confidence. And the operative word here, am I reasonably confident that my strategies can adapt? And this goes back to building the right portfolio and having that diversification we talked to, but it also goes to what Nathan talked about in having policies in place that can adapt to all of our financial concerns, more than just investments.
Second question we wanted to address was, have I considered the tax impact? We list three here specifically: required minimum distributions from IRAs and 401ks and other retirement plans, qualified charitable distributions, again, from those IRAs, and Roth conversions. And it seems that with some regularity, people recognize their decisions have tax consequences. And when they recognize these tax consequences, they often stop making a decision, particularly as things are changing quickly, as there's a lot of uncertainty. And yet, making these tax decisions, being very deliberate about them, can have a meaningful impact on a successful retirement. The three here, they can often go together very closely, and it can be very powerful for early retirees. Take, for example, the Roth conversion. We know many retirees will have required minimum distributions out of their IRAs and 401ks at age 72, but they're retiring somewhere around 60, 62, 65. So they have this period of time where their taxes are going to be lower than they will be for the rest of their lives when their required minimum distributions increase. So there's a decision to be made. Does it make sense to use that tax base to move money out of the IRA into a Roth that accelerates taxes, but potentially and often at a tax rate lower than it will be in the future? Qualified charitable distributions. These are simply, once someone is in RMD, required minimum distribution status, at age 72, they're able to make charitable gifts out of an IRA directly, and it never shows up on a tax return, but it does satisfy that RMD. And now you have these three pieces. You could make charitable contributions that you might have been making anyway. It reduces the RMD, and it might leave tax space to make Roth conversions. Can be really powerful stuff, often ignored, and it's something that can really have a meaningful impact both to the success and sustainability of a retirement and potentially to what heirs receive in the future.
So if you're feeling a little bit overwhelmed by all this, you're not alone. It's pretty normal. One of the number one reasons people seek us out is preparing for retirement. And it's probably one of the largest transitions that you will make in life. So it's really normal if you're feeling some overwhelm. We'd be happy to talk with you. If you go to our website and get on, I think it's under the contact us area, there's some forms you can fill out, and Lily can set up a time for you to chat with us, and we can take a look at where you are and maybe suggest some next steps that will be helpful for you. The uncertainty that's going on right now is, we hope, once in a generation thing to deal with. So not having answers is completely okay. So it's really important now to identify what are the weaknesses in your plans. What do you have to shore up? What's okay? What really needs some action? And the good thing is, if you're listening to us today, you've already taken the step of saying, I want to be aware of this stuff. This is really important. Most people don't. Most people just go on, get into retirement, and they're 2 or 3 years into retirement before they find out, wow, we're way overspending, or there's some critical mistakes that we made in our planning. So we're here to help you get that clarity, help you get confidence in having a plan to go into retirement. So Beth is going to give you some information on how you can contact us.
Thank you, everyone.
Well, thank you for joining us today. We are so glad that you came out and joined us. And like I said, we will have this available to everyone probably within about 24 hours. We'll email out the link so that you can rewatch this webinar. I did want to mention, if Nathan can put up a slide here, one of the things that was mentioned today is that there is a comprehensive list of things that anyone that's going to retire or do any type of planning needs to consider. And this is something that we at KFG have really come up with a list of things that if you have a planner, you want to make sure that they're addressing each of these areas as well. And so we like to share this with people to show them that it's not just a small thing to planning. There are very different avenues with the investments and retirement planning and asset protection and tax planning. And so if you have a planner currently, we just want to encourage you, go over this list with them, make sure they're taking care of you and hitting your every need in that area. That is something that you should have included. So get with them and find out, more, and make sure you're hitting all of those areas, because it's easy to not know. And especially in these scary times of what all has gone on in the last year, there are times where you just maybe at a frozen point because you're not sure what all you need. And so we love to put this out there and say, hey, these are the areas you definitely need to address. So if you are in that area where you're about to retire, think about all of these different areas. And if you need help with any of them, contact a planner. We happen to be a planner, so you can always reach out to us. This is on our website. If you click on any of these on our website, which is KalerFinancial.com, it will give you more information about what you should be looking for, what kind of planning should take place in each of these areas, just so that you can get some education on where you need to be at. And then on our website at KalerFinancial.com, you can there's a button there that says request an appointment. You can click there, and we would love to reach out to you and meet you and have a little bit more information about you and be able to put you on the way to success in retiring in these uncertain times. So we want to thank you for joining us. Like I said, if you have any questions, you can always email us at info@KalerFinancial.com. Also, reach out to us on our website. You can check us out on social media. And we are excited. Our next series will be on divorce and finances and divorce. So you can look forward to getting some more information about that if you want to join us for our next one. We do have our newest employee on our team who is a certified divorce financial coach, I believe is the designation. There's something there along that line, but she's really good at what she does. She understands difficult situations in divorce and finances. And so she will be joining us. So we would love for you to join us next webinar series for that. So thank you all for coming. Thank you, Rick. Thank you, Nathan, for your in-depth experience and understanding and helping us to understand a little bit more. And we want to thank you all for everything today. All right. Well, thank you, and we'll see you next time.